Okay, so why is it that 93% of small business owners overpay on their taxes? And what can you do about it? What can you do so that you don't send thousands of dollars to the IRS that you could be keeping in your wallet? I'm Jim Flauaus. I know this because I have prepared thousands of tax returns over the last 25 years for self-employed small business owners, many of them self-employed contractors who are in the home service business, be it plumbers, pressure washers, people who do window cleaning, painting, you name it, things that homeowners love and need done. And you go out and you work 50, 60, 70 hours a week. And then when tax season comes, it feels like half of that money is gone. Half of it's gone. Why? Because of the single business, the single biggest expense you have in your business, which is taxes. And if you don't believe me, just follow along. More importantly, I want to tell you what you can do to change this because honestly, you're so busy in your business, a lot of times the accounting and the taxes gets pushed off kind of to the side, back burner falls off the stove until you just take, one look at it in April, rush it to your CPA, and it doesn't matter how good a CPA is with your receipts in April. If you don't do some intentional things throughout the year, you're going to overpay on taxes. So let me share some quick slides with you that I think can help me best show what's going on here. So as I said, 93% are giving thousands of dollars to the IRS they don't have to be paying. You're overworking and, building your business, getting projects done, managing your crews, and then boom, it feels like where did it all go? Because when tax season comes, there's a big check to cut. But you don't have to live this way. You just have to have some better information and make some adjustments, like anything in running a business or in life. Always learning. Here's some tips to help you so that you're not out of control when it comes to taxes. So mistake number one, most home service businesses don't know how to structure their business. Sole proprietor, LLC, S corporation, what? Let's just give you an example. Let's say the profit in your business, after all expenses, you're doing well, you're bringing home at the end of the year 100 grand. If you're a sole proprietor, if you're an LLC, that means you're paying $15,000 in what they call self-employment tax. And oh, by the way, that's in addition to about another $15,000 in income tax. So yeah, you're right. That's 30 grand. And that's maybe why you're getting hit with such sticker shock on April 15th. You're saying to your CPA, this can't be right. I don't have 30 grand in my bank account. How in the world can I owe 30 grand to the IRS? I didn't make that much money. Well, if you get more familiar with your profit and loss statement, you probably did make this. And the reason the tax is so much is you're paying two taxes, self-employment tax and income tax. What if you could take that 15,000 in self-employment tax and do away with 5, 8, 10 grand of it? Well, you can, and we're going to talk about that. You can do that by creating something called an S corporation. So an S corporation allows you to split off your profits into two halves of a pie, if you will. So picture a pizza pie, two big halves, and let's say your take home is 100 grand. Well, if you've got 100 grand in the whole pie and you split it into 50 and 50, think of the one half as being a salary that your business is now paying to you. A salary is important because now that will be subject to the taxes that make up self-employment tax, but the other 50,000 is not. So you've got your W-2 income subject to payroll taxes, Social Security, Medicare, which is just self-employment tax in another name. And then you've got the other 50,000 that is your profit in the business after it pays you a salary. That profit, 50 grand, is not subject to self-employment tax. And at 15% tax rate, that's a savings of $7,500. Let's talk about mistake number two. Mistake number two is really the whole way you're approaching your finances. It's often said the difference between having money and not having money is your mindset. You're doing good work, you're taking care of your customers, you're growing your business, but what do you do with the money that you're making? It's really more of a matter of just a mind shift here. What do I mean by that? Most small business owners treat accounting as a once a year event. It's a one-off. You only worry about it at tax time. And you treat taxes like it's some kind of surprise bill. Oh my gosh, where did this come from? Taxes aren't a surprise. They're the biggest expense in your business typically. And so, I mean, again, if you made 100 grand, is there any one expense that's 30,000 or more? Probably not. So it's a huge expense. The shift is you have to treat taxes like you treat your trucks or your equipment. You maintain your trucks all through the year. You change the oil and the tires. You make sure things are lubed. If it's equipment, you're making sure it gets serviced regularly. Otherwise, it's going to just shut down and you're going to have a down day. And you can't treat taxes any differently. Taxes, you can't stop and just wait until April. Stop waiting until April. The best time to save on taxes is all year long. What I mean by that is, are you sitting down with someone at mid-year, June, July, looking at your profit and loss, estimating what your tax is going to be, and then start thinking about what am I going to do to reduce this? And do that again in November. Have an end of year meeting with your tax pro. Mistake, another mistake you make in your mind shift is you need to mix. You are currently mixing your personal and business finances. Maybe you're running them all out of one account. You're paying your mortgage out of your business account. You're paying some business expenses out of your personal credit card. Got to stop that. That's called commingling. IRS loves it because they can audit you and disregard an entity and take more tax money. Look, you want to stop mixing business and personal finances. It makes tracking your income harder. It makes tracking your expenses harder. You start missing tax deductions. You start overpaying the IRS because you've got messy record keeping. You don't want to have holes in your bookkeeping. It just makes for IRS trouble. So here is some quick wins that you can do starting today. One, open separate bank accounts for your business and personal. Now you may be saying, hey, Jim, I already do that. Here's what I'm really talking about. For your business, have two accounts. Have an operations account and then have a tax account. The operations account, that's what you're taking your income in every day, you're running your expenses, but you also have a tax account, which is your reserve. And every time you take in a customer payment, set or transfer 10% of that over to your tax account. You'll be really glad you did. Also, here's something you can start to do now. Track all your expenses immediately. Don't wait till the end of the week, the end of the month, the end of the quarter, the end of the year. Track your expenses all the time. You can do this through a spreadsheet, or you can use QuickBooks and automate this whole process. If you're using a spreadsheet, just make sure you update it weekly. But honestly, if your income is gross receipts over 250,000, which it probably is if you're taking home 100, then you should be in QuickBooks because QuickBooks will not only automate the transactions, there's a bank feed running, everything's running in the background. You don't have to be doing this data entry and categorizing. You can just have these expenses tracked in QuickBooks. And QuickBooks, by the way, also creates something called a balance sheet, which is if you're making over 250 gross receipts, the IRS is expecting you, if you're an S corp or a business entity of anything above a sole proprietor or a single member LLC, you're going to have a balance sheet in your tax return. Third quick win, get expense savvy. What do I mean by that? Well, do you really know what is coming out of your bank account? I'm shocked sometimes, even in my account, which I track daily, some of the stuff that comes out of it. These subscriptions, these memberships, these things where they trick you into getting, a recurring monthly. And not only that, you want to know what's deductible and what is not. There are some anything that is reasonable and customary in terms of an expense to generate income is deductible, long as it's reasonable. But you want to know this not just for taxes. You want to know this because hidden in your record keeping is a story. That story is going to tell you how to make more money, build more profit, have more cash flow. So being expense savvy builds a business that works for you. At the end of the day, you want to take control of your taxes. You don't want to just be this guy who's surprised or the gal who's shocked in April when it's tax time. And you don't want to be working with a CPA who just calls you once a year and tells you what you owe. They put last year's numbers on last year's forms. It's all writing history, but they never helped you reduce your taxes. Subscribe to our YouTube channel for more information on how you can take control of taxes. And if you want to schedule a short discovery call where we could just see what you're doing now, whether it might make sense for you to have a tax professional who can help you monitor your business, reduce your taxes, forecast your cash flow, and just start to take control, then here's the link. Book a strategy call at tinyurl.com/anchor tax call.